Hello and welcome to this Nouveau post-budget workshop. I'm Giles Lang, Senior Tax Partner, and joining me is Chris Littlewood, Associate Partner. And in this session, we'll highlight the key points from the budget and share our initial thoughts. I am, however, a little reticent about giving too much at this stage, as the devil is always in the detail. Now, Chris, you work with a diverse range of clients, from landlords to construction business owners. In your view, which groups do you think have been most affected by this budget?
So, it's the individual small managed businesses where they are trying to be tax efficient in their own rights, where that has been chipped away. It's those small changes that are going to impact them. In terms of other areas, it's those that are employing individuals between that 18 and 20-year-old threshold, where national insurance, national minimum wage has changed, so it's small incremental costs, but slicing it in multiple areas, which is going to potentially add up to individuals that get caught in those broader remits.
And so with that, I think it's probably a good idea that we go through and the key changes and any queries that people have online. We'll look at those at the end. So first, we'll start with the freezing of the income tax threshold. Now, the last time that rose, it was in 2021, and now it's going to be until 3031.
Yeah, this is that infamous fiscal drag. It's in effect, we're not going to change the thresholds because we hope more people are going to get pay rises, more people are going to earn income above those thresholds, and we're going to be able to tax more people because we are not increasing your ability to get higher rate tax-free allowances or increase your basic rate banding. But what they've actually done is encourage more people to fall into the tax as the years progress.
Yeah, absolutely. The next point I saw was the increase in dividend tax rates by 2% from April 26, as I understand it. That's going to be a massive impact, I think.
Certainly for owner-managed businesses where they have been remunerating themselves in tax-efficient structures around those tax-free allowances for your salary, then topping up with dividends. Am I now better off on that dividend remuneration strategy, or should I be looking at whole salary strategy in terms of where I'm going to be for extracting my money to live off out of my limited company?
The next increase I saw was on savings and property income.
Again, another 2%. Yeah.
Another kick in the teeth for landlords.
Landlords have had a horrible time over the last few budgets in terms of basically there is no encouragement for individual landlords, but it's not as bad as what people feared. We were fearing an 8% national insurance charge on landlord earnings, and what they've done is not implemented that. They've gone for a 2% charge on the income.
Do you think we'll see more clients potentially wanting to go down the incorporation route?
It is a strategy at the end of the day, but it's one of those where you'd have a conversation with your accountant to make sure the plan is right for you and what you're trying to achieve as an individual, as a family.
Next that I found was the restriction on the salary sacrifice on pension contributions.
Yeah, that one was a bit of a shock to me. I mean, I know they had hinted at it, but you think of how they abolished the salary sacrifice scheme overall and just left pensions, and now they're saying there's a £2,000 cap on that. Where's the encouragement for people to put into their pension if they're gonna,
And then we have a few other smaller changes that I saw was the increase in national minimum wage for 18 to 20-year-olds.
Yeah, I think that's more of a catch up around the age, because I mean, the over 21s is in terms of where the next bracket is. So you are going to see that it's those hospitality employers, the restaurants, pubs, things like that, where they potentially got students in covering while they're at university, things like that, and it's those that are going to, have to be paid that additional rate now.
Reduction in the capital allowances.
So they're basically saying that in terms of your pooled investments, so in terms of your asset that you're holding in your company that you haven't had your 100% write-off as annual investment or first-year allowances, so anything you've got in your pool you're carrying forward, that main rate pool, they're looking to reduce that rate. So it's currently 18%, but again, always in the detail as to
Yeah.
what that new rate's going to be and what's actually going to be swapped up by it.
Yeah. Do you have any inclination of what they'll reduce it to?
No, but you'd be thinking, 16, 15, 16%. If you're upping it by small increments, then I would expect to see that.
And then another change was to the electric vehicle. So there's now going to be a 3 pence per mile charge, which I believe is going to be collected with the vehicle duty each year. Deal with that.
No,
but-
the implementation is always their responsibility at the end of the
Yeah.
day. The government push out what they want in terms of how they want to achieve this.
Mm.
But you think about it, say I've got an electric car, all of a sudden I'm going to get taxed per mile. Anybody that's got petrol or diesel has already been having that. We've had the fuel duty,
Yeah.
which has obviously been frozen this time for a few months.
And finally, there's the new mansion tax. I don't know how many people that's going to affect. There's an additional council tax surcharge for properties worth over £2 million. They mentioned £2,500 annually.
A strange tax to me because they have kind of done this same sort of thing in terms of limited company ownerships of private properties under the ATED scheme.
Yeah. Shall we have a look at some of the questions that are coming through? Now, I have an issue reading that. so
No, and you would thinking that when you're looking at a business, HMRC's position is that if a cost is wholly and exclusively for the purposes of the business, it's a deductible expense of the business. But we don't know how this road levy mileage tax will work in that case. But if you're using that vehicle for business purposes,
yeah,
it may be that there is a remit there to offset
yeah,
as an expense of the business. But again, it's
yeah.
the devil in the detail.
Yeah.
And that's what we need to figure out for clients once it gets pushed
There
out.
could be a cost. Now, I know the dividend tax rate increase was going to be from April 26 by the sounds of it. I would expect the same be for savings and property income as well.
It tends to be the case that it is effective from the next tax year.
Following tax year.
Yeah. Especially certainly as they've gone for this low threshold as well.
That's correct. It'll be for personally owned properties where you're receiving income as an individual rather than through a company, which is taxed under corporate tax rules, which is
basic rate payers are going to go from 20% to 22%. An individual landlord is still going to be restricted from their Section 24 finance. So they're not going to get full tax relief on their finance if they're a high rate payer.
Yep.
And that 40% income tax rate becomes a 42% income tax rate.
How's it going to work for company car tax?
So at the minute, you're on your benefit in kind tax rules for the 2% rate. As I say, they've gone down this mileage levies, whether that's the equivalent of the fuel levy, and then maybe then they would look to increase the benefit in kind rates at some point. But at the moment, they are still incentivized to have electric cars more than they want. So no, so annual tax on evolved dwellings, that is a specific tax for properties over £500,000 in value, which are owned by a limited company. Okay, you only are required to report that if it is a residential property and it is not being used for a rental business. So in terms of what you get is some people think that's an exemption. It's not an exemption. It is a nil reporting standard if you are using it as a rental property. Good question. So at the minute,
it's thinking about
it's
that.
It's 20%. Yes. So in terms of that, it's a tax reducer at 20% mortgage interest at the moment. Now that was to keep it in line with the basic rate of tax.
Yeah. Is the basic rate for
now
property income going to be 22%?
That's the kicker, isn't it? Is it basic rate stays at 20% with a 2% surcharge, or is actually the basic rate uplifting to 22?
Yeah.
And therefore, again,
an extra kick in that for landlords. So yeah, again, that is something that will come out in the detail, and I'll say that we will be covering a lot of these questions that we can't answer today.
So again, say this wasn't something that really came up in the budget. This was just information that the rates for the changes for the tax are around the £2 million value of property and a £5 million property. The 500,000 threshold is a limited company owned residential property. And if that is being used for business purposes, such as a rental property, it's not an exemption. It is a relief that you pay zero ATED tax on it.
So the excess salary sacrifice on pension contributions and the cap of 2,000. So I expect it will be the 2,000 will be continue to be the relief. Anything in excess of that will be treated as salary, I guess.
So this is in terms of the HMRC's basically saying that they don't want to put pensioners out of pocket for small taxable incomes. So in terms in the detail of what they are setting as any thresholds in terms of captures or not captures and how they want to address it. So what they've done in here is to say, well, right, we're going to tax the workers towards their pension, but try and offset so those that are actually drawing their pension don't pay tax on it if they're at the lower end.
But so this is a question on the mansion tax, and in 10 to 20 years time, majority of London properties will be more than £2 million. And yes, that if the tax is still in at that date, I expect there will be a tax. Mansion tax does not exempt rental properties.
No, so in terms of that, it's the value of the property. It's a council tax surcharge.
Yeah.
So rental properties which are AST assured short-term tenancies, long-term lets, those won't. If you have a furnished holiday let temporary accommodation property where you are using the business rates model, potentially so. But again, it's the devil's in the detail as to what they value, what they are going to do with
So this is a question on the salary and dividends and whether we have an inclination of what will be better. That is going to come down to a calculation. So we've only just seen it, so we don't know yet.
No, you've got to think that when you're talking corporation tax, your corporation tax relief is 19% for the first 50,000. When you're a large business and you're earning over 250,000, corporation tax is a flat 25% rate. In between those thresholds, though, it's an effective tax of 26.5%. Right. So this question is around the £2 million threshold in terms of the mansion tax. And in effect, what we've got is a multiple dwellings position here where we've got flats with inside a single unit. Again, it's going to be in the detail on that. But under most other tax rules, it is per dwelling in terms of where that valuation sits. So stamp duty, land tax, ATED tax, all those sorts of taxes are based on dwellings and not the pool of the dwellings. So, if your pool of flats is £2 million, it shouldn't be the mansion tax if they're going to apply the existing rules for other taxes. But again, we don't know. So there's a heck of a chunk in terms of that. So we're looking at the change in the rules about the 100% relief for employee trusts in terms of ownership and dropping it down to 50%. At the end of the day, this is again going to be on individuals' exit strategies, what they're trying to achieve. Are they trying to pass on a business to their employees? Are they using this as a tax planning strategy tool for exit? And again, what becomes available as an alternative option. So, we would need to again look into what they are saying that pins on and what basis they're going to be applying these sorts of rules.
Yeah, there'll be plenty of planning opportunities to be had. Okay, then we're done.